morning, everyone, and welcome to the 112th episode of the Veritas Fact-Finding Series. And this morning, I'm joined by my good friend, Michael Jantzi. Good morning, Michael.
Good morning. It's good to be here.
In each episode of the fact-finding series, we go on the ground to speak to industry professionals in an unscripted, candid, live video format to discover how we can make better investment decisions. In this series and with everything we do, we believe the facts empower investors and that better information leads to better investment decisions. If you're watching and you like what you hear, give us a like and follow us at www.veritascorp.com. By way of background, my name is Anthony Schlapati, and I'm the CEO and president of the Veritas Group, which is an independent equity research group based in Toronto, Canada. And I'm proud to say this year we'll be celebrating 23 years, 100% employee owned and operated. Quick disclaimer, this broadcast is not to be taken as investment advice, and participants or employees of the Veritas Group of companies may own securities discussed in this broadcast. While we love all our guests, and Michael in particular, this session may contain forward-looking statements, investment opinions, and comments that we do not agree with at all. Now, on with the show. Michael Jantzi is, ESG has been on the tip of investors' tongues for now a number of years, and it's gaining more and more momentum. And Michael Jantzi was talking about ESG before anyone knew that ESG actually stood for environmental, social, and governance. I'm going to go back to a time, 1992. Michael founded a company called Jantzi Research, which was building the groundwork for sustainability reviews and risks. That, after multiple acquisitions, led to what was, as we know, Sustainalytics. And that was formed in 2009. And then in 2020, Morningstar saw the opportunity and purchased Sustainalytics, from Michael and his partners. Now, he went on to serve as managing director, and I believe you're now retired from that role, correct, Michael?
Yeah, that's correct.
Now, Michael serves on a number of other boards, as you can well imagine. One's interesting, the Value Reporting Foundation and the Principles of Responsible Investing. He has a Master's of International Relations from Dalhousie University in Halifax, Canada. Michael, thank you for taking the time to be with us.
Oh, my pleasure. Look forward to the next hour.
All right, we're going to be hitting the ground running here. We're going to talk about three key broad areas. First and foremost, we're going to learn about Michael's background and understand what exactly does the International Sustainable Standards Board do, and why it was formed, who's on it, etc. Because I think this is an important, it just started last year. And was formed. And so Michael's on that board, and understanding in the next part how the new standards that have now been issued, we're called S1 and S2. And then lastly, we're going to discuss how should investors actually use this new information, this new disclosure that's expected to be coming out starting next year. So with that, Michael, why don't you tell us in your own words a little bit about yourself, why you're on the standards board, and we'll take it from there.
Yeah, well, thank you again for the invitation to be here. Look forward to the conversation. My history in sort of sustainability of the sustainable finance space, as you highlighted, started in the early 90s. And, investors at that time, I wouldn't say sustainability had a deep traction with them, but there were a certain component of investors, both institutional, but also retail, the individual investor, that wanted to invest in a way that was going to drive competitive returns over the long term, but in a way which was aligned with, organizational mission or personal values. And there wasn't a lot of research out there to help investment professionals determine or evaluate companies based on their environmental and social performance. And so that's what Jantzi Research was all about, trying to bring some, analytical rigor to that, an approach that investors could trust. And we launched that, as you said, in 92. But I think it's fair to say, Anthony, at that point, sustainability data and investing was a nice to have at best. It was probably not even that. But through the years, and I'm not going to go through that, year by year, but we moved, I would say, from a nice to have environment for sustainability information into a need to have. And that was certainly an evolution over many years. But I would argue by 2015, 16, in there somewhere, that shift began to happen, especially for institutional investors. And they, around the world, in talking to chief investment officers, portfolio managers, sell side analysts, it became clear that sustainability information was important as part of the investment process, because sustainability issues, environmental, social governance issues, can represent risks and opportunities that professionals needed to understand as part of their evaluation of a company or a portfolio. And, the sustainability information wasn't looked at in isolation to all of the things you look at and we look at traditionally in investment analysis. It was integrated into that. It was about making sure that we had, an accurate picture so we could evaluate the risk return paradigm. And so when that shifted from a nice to have to a need to have, I mean, it's like anything in capital markets, as you and everyone on this call knows. It means the job we need to do as professionals gets ratcheted up, right? I mean, the timeliness of the data, the quality of the data, all of those sorts of things. So one of the gaps, Anthony, that had been a challenge in sustainability for many years, but it became more acute of a challenge when we shifted into this new need to have era, was a lack of globally aligned, high quality, comparable, auditable, assurable disclosure. And so that became something that, even as CEO of Sustainalytics, I started to spend a lot more time on. And eventually, that sort of led to the establishment of the International Sustainability Standards Board by the IFRS Foundation. So I'll stop there, but that was sort of my personal journey in building Sustainalytics from a Canadian entity through the years, through consolidation and growth to a global player, and then making that shift to becoming a standard setter with the ISSB.
So the ISSB was formed last year, and there has been prior to it, there were a number of other organizations that were setting, let's call it standards and or regulations, or giving guidance on how sustainable disclosures and or accounting should be presented. Maybe you could just talk to that, because I think that's important for those on the call to understand where the ISSB standards fit in related to the marketplace.
Yeah, you're absolutely right. In fact, what I referred to it as, and we referred to it at the ISSB, there was an alphabet soup of sustainability disclosure standards globally. And that's not to deride or critique any of them, but they'd grown up in an environment where, again, sustainability data was a nice to have for investors in different jurisdictions. Different bodies felt it was important to get disclosures, in any way that was possible. So we saw some jurisdictions launch them. We saw some global initiatives. We saw stock exchanges. So it really was this alphabet soup. But what happened through this transition is the need for, what we've had on the financial reporting side for a long time, sort of financial reporting that we can trust to a certain extent, as you well know in your business, but we needed something in sustainability. And this challenge or this issue landed on the radar screen of the IFRS Foundation. And I'm sure the IFRS Foundation is very familiar to you and people on this call. I mean, it's the IFRS reporting standards, which are used in over 140 jurisdictions, including Canada.
Yep.
And this was new, but it landed on their radar screen. And I think one of the main parties that sort of placed it there for the foundation was IOSCO. right? So the umbrella group for securities regulators around the world was becoming more concerned that this data, again, wasn't global, it wasn't aligned, it wasn't high quality, and those sorts of things. But the IFRS Foundation just didn't launch the ISSB. They went out to the market and they asked three questions, essentially. Do we need globally aligned sustainability disclosure standards? If so, should we at the IFRS Foundation be the ones to launch them? I mean, those were sort of the two key questions. And they, if you know anything about the IFRS Foundation, very strong due process and oversight. They do a lot of market consultation. They got a lot of response on this, and it was overwhelmingly positive. The market was saying, absolutely, we need these standards, and we need the IFRS Foundation to create a sister board to the International Accounting Standards Board, the IASB. Yeah. And that then the trustees made the decision to launch the ISSB. It was actually launched in November of 2021 at COP26, I guess it was, in Glasgow. And then things moved very rapidly, in a sense, certainly more rapidly than I experienced standard setters in the past, and probably you as Definitely. Well. And, Emmanuel Faber was named as the chair, I think in maybe December or January of 2022, vice chair. And we had our first two exposure drafts for the general disclosures, which was S1 you referred to, and climate disclosures S2, was into the market in March, by the end of March of 2022. Yeah. And the only reason we were able to do that was because as part of the announcement, the IFRS Foundation also acquired the Value Reporting Foundation, which included SASB, which the SASB standards had been around for a long time, very strong usage in Canada, the United States, and globally, which people might be aware of. They also acquired the Canadian or the Climate Disclosure Standards Board, which had worked very closely with the Task Force on Climate-Related Financial Disclosures, TCFD. And then we also worked very closely with the TCFD. So immediately the foundation, the IFRS Foundation, wanted to address this alphabet soup. We had no intention whatsoever of adding to it. We didn't want to add another letter to that alphabet. So we started consolidating investor-focused disclosure standards that had already been in the market, had a lot of credibility with investors. And those standards inform our work to a great extent. So we had a really nice head start being part of the IFRS Foundation, which had a deep, just deep traction and credibility with regulators, with preparers and investors, obviously was a huge boon. So that allowed us to move fairly quickly. And then we released the standards in June of last year, our first two standards. Or sorry, not of last year, this year. This seems like last year. Yeah, 3 months ago. Yeah.
Okay, so that's very interesting. I just want to remind everybody, if they hover down to the bottom of the screen over their Q&A symbol and they type in a question, I'll make sure that Michael addresses that again here live on our show. Michael, okay, so that was great perspective, and if anybody didn't follow all those alphabet soup of letters, you can look those up, Google them, and you'll see the points. Now, I want to dig into what is S1 and what is S2. So let's take them in order. Let's talk about S1, what it means, and of course, then how should investors use this new information?
Well, I think the really important thing to remember is that the ISSB standards are meant to provide disclosures on sustainability risks and opportunities that are decision useful for our primary users. And our primary users are investors. Yeah. And so we, as a board, are laser focused, or we're laser focused on ensuring that our disclosure standards were focused on the information, the sustainability information about risks and opportunities that could be material to an entity's performance over the short, medium, and long term looking forward. So our standards are meant to provide, again, that decision useful information for investors. We recognize there's different stakeholders beyond investors that are interested in sustainability information, but that hasn't been and isn't our focus. So it's about investors, other allocators of capital. So, that has been our focus. So S1 is, you can think of it as almost a conceptual framework in a sense, but it's really the disclosures on generally related sustainability risks and opportunities. And it provides sort of the blueprint for how preparers need to think about disclosing to their investors on sustainability risks and opportunities. And there's a couple of things here that I think are really important to highlight, because this is really, that core focus on financial materiality, the sustainability risks and opportunities that can be financially material over time, is something that's embedded both in S1 and S2, but that is the foundational element of S1. It's also a document that makes clear that we expect connectivity with the financial reporting of an entity. So we are a sister board, we're independent, but we're a sister board to the IASB.
Yeah.
But in sustainability disclosures, in S1, it highlights the fact that we expect that the reporting entity on sustainability disclosures is the same as it is for financial reporting. We expect the timing to be aligned on reporting. So that's been one of the challenges in sustainability reporting. A sustainability report or whatever it is comes out 6 or 8 or 12 months later. That's difficult for investors to match up. So timing, we talk about. The assumptions that we have in sustainability reporting have to be aligned with the assumptions that that entity is using in financial reporting. And maybe there's 2 things here that, Anthony, I'll say, I think are game changers in regards to the ISSB standards, and they're embedded in S1. But first of all, the expectation is that these will become mandatory. They will become regulated. Now, it's not within our mandate, and we don't have the authority or the power to regulate, obviously, the standards across jurisdictions. That decision rests with security regulators and others across the world, just as with financial reporting. But we do expect that they will be regulated, and we've already seen some announcements of early adoption or proposed early adoption. And so they'll be audited, assurable. So they've been created with that in mind. So that changes the game for sure. But the second thing is, and this is I think the first time we've seen these in sustainability disclosure standards, is that in addition to the expectation that companies will need to identify the sustainability risks and opportunities that are material to their business, they will also have to disclose how those risks and opportunities will have an impact on current and anticipated effects. So it's the linking, right? It's the connecting of sustainability risks and opportunities and the disclosure of those with the anticipated impacts on current or anticipated financial effects. So that's what S1 is primarily about. It's about the broad-based sustainability risks and opportunities, the disclosure of those, how preparers can go about identifying those risks and opportunities, and then the expectation of how those need to be disclosed. And again, the connection with the financial reports and the financial reporting of that entity.
And I think it's important, if I could be a little more explicit, because I remember this when I was because I'm part of the Capital Markets Advisory Committee to the ISB, and I remember when you presented sort of when we discussed the framework, the point about materiality. The materiality that the ISSB is using is the same materiality that we use on the IASB for accounting standards. So it's based on a financial framework. okay, which is tied to the same level of materiality. If a company is being audited in the materiality level, we set it as a percentage of revenue or as a percentage of income, depending on the situation. But that same metric is what gets used when sustainability standards are being presented. And I think that's important. It highlights even further Michael's points that these disclosures are intended for users to make decisions and about the current and expected financial effects of the environmental at this point, because that's what this is going to talk about. And we're going to talk about a little later, why is it we don't talk about anything to do with the S and the G, the social and the governance, because that's a very explicit decision that was made. And so I think that's an important point for S1. How do you think that investors should use that? Should we talk about that now, or should we go through S2? But maybe we get to.
Well, why don't we touch on S2 just very quickly, because
perfect. S2 is more specific. So let's get to S2. Yes.
Yeah, and it's focused on climate. So while
Right.
S1 is about, sustainability risks and opportunities more broadly, and again, it's within the purview of the preparer of the company to go through that process. They need to go through a process, but they decide, based on inputs from a range of different stakeholders, no doubt, on what those risks and opportunities are that are financially material to their business. And if they decide that climate is one of those issues, then they need to look to S2 in regards to how they are going to disclose on climate-related risks and opportunities. And so S2, as you say, is very specific to climate. And for many reporters are familiar with the recommendations of the Task Force on Climate-Related Financial Disclosures, TCFD. I get confused with the acronyms. Now, TCFD, we've borrowed the architectural foundation of those recommendations, and they're embedded into S2. So again, companies will need to disclose on governance, on strategy, on risk management, and then on targets and metrics. So those things are very familiar to Canadian entities and entities around the world, because they've been using TCFD recommended disclosure regimes now for several years. And in fact, the Financial Stability Board, and I should mention this because it's important, announced in July that they're passing on the TCFD recommendations to ISSB. We are the standard-setting legacy now of TCFD because they're fully embedded into our standards. And so so that is again another example of how we're addressing sort of the alphabet soup. So, I mean, the TCFD standards or recommendations are still there, but they're now part of the ISSB S2, which is quite exciting. But with climate, again, it's about identifying climate-related risks and opportunities that are material to the business. I'll just highlight a couple of different things for preparers, Anthony. It includes disclosures of scope 1, 2, and 3 carbon emissions if they're material to your business.
Yep.
Investors, and the ISSB went through a very comprehensive consultation process as well for 4 months, which also included hundreds and hundreds of meetings with key stakeholders around the world. And I will tell you, one of the things that investors globally were pretty much aligned on was that in order for them to understand business models of companies, they needed to have emissions on scope 1, 2, and 3. They also, to understand how a company is positioned in regards to its resiliency to climate risks and dealing with transition and those types of things. The only way that as investors they can fully understand the resilience of a company is to have disclosure on climate scenario analysis. So there's an expectation that companies will undertake climate scenario analysis. So that's important. And then for financial institutions, for example, we expect disclosure on financed emissions. So again, which is part of that value chain. So there are some things in there that we know are in their infancy in regards to companies grappling with and disclosing.
Yeah.
And the last thing I'll say, and this is built into S1 and S2, and it goes back to your comment, how we at ISSB borrowed from the IASB, and I think financial materiality in that definition is a great example. Thank you for highlighting it. We've also built proportionality into S2. And so we like, listen, investors don't expect perfection from companies, from reporters right off the bat. But and just like in financial reporting, we're using terms and borrowing word for word the same constructs that you are familiar with from the IASB. So reasonable and supportable without undue cost and effort. There's an expectation that companies will report, commensurate with their, capabilities, skills, and resources. So those sort of proportionality mechanisms are built in, but they're, again, the expectation in S2 is that investors for the first time will have the ability to have access to information that is high quality, it's comparable, and will be audited and assured.
So just so everybody is clear on the points of level 1, level 2, level 3, perhaps you could just quickly make the point, because level 3 is actually not required, if I understand correctly, right now. And you did mention that there's some scope-ish points related to size. So just a couple of little clarification points there I think are important for our viewers.
Yeah, well, it's really important to know that, we're not asking companies to report on everything, including the kitchen sink. The materiality lens is really important. So the expectation is companies will be reporting on sustainability risks, or in this case, climate risks and opportunities that they believe are material to their business or could be material to their business.
Yes.
And so scope 1, for example, those are their own emissions, direct emissions. Scope 2 are those emissions that are related with their energy use. And then scope 3 are the emissions to their value chain, right? Up and downstream. And
suppliers and customers, and that's really the toughest one.
It is the toughest one. You're absolutely right. Now, again, as part of the proportionality mechanisms, with S2 and climate reporting, those will be effective from our perspective starting January 1st of next year, which means reporting in 25 on the 24 fiscal. But you're absolutely right. I think this is what you were referencing. We recognize that with scope 3, because it's a little bit more nascent, there's more learning to be done there. There's more work to be done. Again, no expectation of perfection because proportionality is built into that. But we did provide an additional transitional relief there of 1 year. So the expectation would be that, the reporting year would be 25. As an example, and then you'd see reporting in 26.
So to be clear, these standards have now been issued in draft.
No, they're issued in final form now.
Okay, in final, and they're expected companies with as of their year-end dates in 2020, any year-end dates as of 2025. Is that correct? So if you have a year-end of 2024, it's not going to show up yet.
Well, Well, for us, the effective date is January 1st, 2024.
Right. That's what I thought. Okay.
Yeah.
So we could expect this starting next year's year ends, which will show up in 2025 when they're actually published. And
that's exactly right.
And it's important that the timing point you made, because we're going to get annual reports, or 10Ks, et cetera, and we'll get this as part of that at the same time, as opposed to significantly later in some cases, which has been the case.
Yeah, that's absolutely right. Now, we did provide some transitional relief in timing for the first time out, because there could be some challenges there. But I want to be very clear. The expectation is, and in fact, the standards say the timing of these reports needs to be aligned.
All right.
And that
we're gonna take a question from another expert really on ESG, Professor Charles Cho. But I have a question also. We're going to discuss now after this. We'll discuss how investors should use this. And we're going to go a little bit over time because I like to keep these things tight at 30 minutes, but we'll probably go over that time. But I think it's going to be very important because we're going to also discuss how investors should use ESG ratings that are currently being published, whether they're coming out from Morningstar or MSCI or others. There's something to really consider about what's happening and how investors should be using that along with this. Okay, so good question here. The ISSB has explicitly stated that the sustainability standards it will issue, and they've already been issued, will be focused on investor needs, risk management, mitigation, etc. In short, ESG. Clearly, this single financial materiality, outside and in approach, does not bode well with the protection of the planet, actual social and environmental issues. In fact, it's detrimental. How do you feel about this market-focused approach? In what way will the ISSB address planetary issues? Deep thoughts.
Yep. No, it's a great question. And let me just, so I understand the question. I think the question here is there's terminology that's called sort of referred to as single materiality, which I think Professor Cho just said was, referenced as outside in, and there's something that sometimes is referred to as double materiality, which is the idea that, so outside in is that as investors, obviously, as we evaluate risks and opportunities at an entity, we're looking at outside or external factors to a sense, and the impact that sustainability issues, for example, might have on that company, and making sure that as investors, we are clear whether or not the company understands those external challenges and how they're managing those risks or trying to leverage those opportunities. Double materiality is a construct that says, well, in addition to that, as investors, should we not take an inside-out approach as well and intentionally think about the impact that we as companies or whatever the entities have on different stakeholders. So that's the inside-out perspective, sometimes referred to as double materiality. And in one sense, it's right. Like at the ISSB, we are focusing on what decision useful information is for investors. And I can tell you overwhelmingly, our investors have told us to focus on, disclosures of sustainability and risks and opportunities that are financially material. And so that has been our focus. But we're well aware of the fact that materiality is dynamic. I mean, that in your business, that's you have highlighted over your 23 years that issues that maybe some folks didn't think were material to financial performance certainly are. Mm-hmm. And that's what the ISSB is doing to a certain extent. And so the fact of the matter is that it's entities that preparers that are expected to define what's material for their business. And they're going to do that informed via a number of different ways. And obviously, they're going to inform what's material to their business, in large part, one would expect, through conversations with their stakeholders, including investors, including regulators. So I think we're well aware of the fact that materiality is dynamic. And I think that we're not so rigid at the ISSB to say this is what's material and not. That's left to the preparer. And so, I would say, from my perspective, and this is my individual perspective, provides a proportionality and a scalability in regards to what we're doing at the ISSB. But the question's absolutely right. We are not, at this point, creating disclosure standards to measure impact. That is not our
impact on the planet, etc. It's
exactly.
And now
the one area that I disagree with the question is that the work we're doing isn't positively impactful on the planet. I would disagree with that. I would say that, even taking a financial materiality, investor focused disclosures with companies thinking about these issues, with companies managing these risks, with investors allocating capital in part based on this information that can have positive planetary impacts. So I may take exception to that statement, but it's absolutely right. We're not intentionally creating impact standards. Now, and I know I talk a lot, but there's one other point I want to make here, and that is that the ISSB is also not saying that that impact side isn't important. We've never said that. What we've said is it's not our focus. It's not our job. What we understand at the ISSB, and I certainly understand through my more than 30 years in this business, is that an increasing number of investors do care about the impact side. So what we have done at the ISSB, one of the things we've done to address that is to say, there are other disclosure standards out there that are attempting to measure that impact side. One of them being the Global Reporting Initiative, the GRI. And we have a memorandum of understanding with the GRI and are looking to work more closely with the GRI, with ISSB focusing on financial materiality, GRI, for example, focusing on impact. And those conversations and that work is ongoing. And I will anticipate, I don't have a crystal ball, that you'll see more information coming out on what we're going to be doing together over the next several months.
Great. Thanks for that, Michael, and thanks for the question. Okay, I want to wrap this up with how investors should use this new S1 and S2 information and how it's going to play with the numerical metrics that are already being presented. I mean, I go on my Refinitiv today, I hit a button, and bang, there's an ESG rating there on every company, which is a number. Help us.
Yeah, well, you're talking to someone whose career was based on creating ESG ratings. So I mean, I think they certainly have a place. I mean, the way that I look at ratings is that these are put together by professionals, experts in sustainability, and so it gives you a sense of what their belief is in a company, whether it's based on sustainability, like a risk approach or an impact approach. But it's sort of like sell-side research at the end of the day. So, do you rely on that, in traditional parlance, that buy, hold, and sell rating, and put that, how much weight you put on that rating? Or are you more interested in the way that analyst or that team reached that conclusion? And so, I think that increasingly investors are not as much interested on that final rating as they are in the journey that company or that team got to get there, which means there has to be transparency in the data. Yeah. Like at Sustainalytics, in my old life, I said, at the end of the day, you can agree with the rating that Sustainalytics or MSCI or Refinitiv or any company puts on something, but whether you agree or disagree, you as an investor have to know how they got there. Like, how is that company being evaluated? There has to be transparency there. Looking where environmental, social risks more heavily or less heavily weighted. How do you, from a metric standpoint, evaluate environmental performance, social performance? There has to be transparency there. And that's what, from my perspective, investors are increasingly interested in. They want to know, because they'll have their own take on these things. Interesting to know what other professionals think about it. But at the end of the day, they're focusing on their own thesis, their own narrative, their own analytical models, and they need the data to make sure that those models are as robust as possible. And getting back to your question, that's where the ISSB standards are really going to, I think, raise the game here. because we will see disclosures now over time as they become regulated and mandated. You will now be able to compare sustainability performance globally across larger portfolios. The information will be comparable in ways that it hasn't before. There will be fewer gaps in that information that we've seen through voluntary or no disclosure. And maybe at the end of the day, investors will know that this data eventually, it will be assured, it will be audited. And so the quality or the certainty that investors have, I think will increase dramatically. Look at, as your business has highlighted for the last 23 years, audited statements are not perfect, right? Auditing and assurance doesn't mean it's not about perfection. So it's not the end of the journey there, but certainly the gap from where we are now, which is voluntary standards, no assurance, no, little comparability to where we're heading is huge. And so I think that's how investors will be able to use the standards. They are going to get specific disclosures on the issues that we believe are financially material to company performance moving forward on the sustainability front. And that is a huge jump forward, I think, for investors. Still using ratings because they provide, a third party take, which can be exceedingly useful. But again, I think from my perspective, again, for ratings to be useful in their truest sense, users of those ratings need to be able to have transparency to understand what's being rated and how.
I love it. And this came up in our discussions. I'll summarize it this way. Broker A has a buy rating, broker B has a hold rating, broker C has a sell rating. Those are interesting at the source, no different than in the ESG world, where each of those will have a different numerical number for the same entity. But that's not a bad thing. While we look at this at first and say, well, shouldn't it be consistent? It's like, no, that's where your second point comes in, where it's understanding how did broker A come to the buy rating? How did broker B come to the hold rating? And same with the C. And so the same rigor is required here as investors consuming this source of information to say, okay, do I agree with the issues that or assumptions that were made to come to that conclusion of buy, sell, hold, whatever the rating is. And I think if we keep that perspective and then use the financial statements as that are now going to come out, S1, S2, as sort of a check, as sort of a ground base for where the source of the information is, no different than we do today when we look at audited financial statements and then get a report from Veritas and get a report from other sources and use those to compare and then using the source data as a key reference. So I think that's important to put all that into perspective. I'm going to launch our poll here so everybody can tell us what a great job you've done for us today, Michael. And the other thing, if anybody has any questions, please feel free to scroll over the Q&A again, and we'll make sure Michael asks the question. Michael, we're taking a first step. We have S1, we have S2. We've really focused on environmental. And even this is going to be a challenge. Like I've talked to some on the preparers side thinking about level 3. I mean, what my supplier's doing and what my customers are going to do, this is heavy. But that's, it's good that we have goals and we know we get there. Can you maybe think about, obviously we need to think about S and G. Mm-hmm. How are we going to get there?
Yeah. Well, so the first thing, let me just remind you, like S1 is there, and that's the broader base of sustainability risks and opportunities, including S and G. I referenced the fact that, governance is embedded in both S1 and S2. So, let's just take S2 again on climate. There are disclosures that are expected from entities in regards to their governance of climate-related risks and opportunities. Yeah. The distinction between board and management responsibilities. Investors said they want to know whether board directors have the skills, capabilities, and resources to understand these issues. So governance is there. The one thing is that, Anthony, I didn't talk a lot about this, but investors historically, and certainly with us, told us that industry-based standards are really important to them. So the general, climate standards important, but I mean, sustainability risks and opportunities can be very specific to particular, your industry, your sector, your business model.
Mhm.
And so those are also built into S1. And we've leveraged this SASB standards that have been around for 10 or 15 years, which are now part of the IFRS Foundation family or the ISSB family. So they're there. And there's large acceptance in Canada, for example, of the SASB standards. So I don't want to leave the impression that we've left S&G completely. They are there. Now, moving forward, we're in the midst of an agenda consultation. On that list of prospective issues, we might dig into more carefully are human capital issues and human rights issues. So two big issues that fall into the S bucket, as you would say.
Yeah.
We'll have more clarity on that by the end of the first quarter next year, when we'll go through a very public process now and evaluating. We had over 400 consultation responses, including from investors around the world, giving us their perspectives on what we should focus on. I haven't had a chance to go through those. The staff will be analyzing them, and we'll deal with them for the first time at our October board meeting. So
Right.
We'll see how the market wants us to. Do they want us to shift focus now on more S issues? Do they want us to continue on looking at more E issues on biodiversity? Our decisions will be informed by our market stakeholders, in a large part, investors.
So I'm going to make another plea, which I've made many times, is that, investors on the call, you have to respond. You have to send in comments, make noise. Otherwise, the standard setters, we're not going to, hear you, because we don't know what you're thinking. And too often I see this happen. Standards get set, and then all of a sudden investors call me and say, how did we come up with this? Why did you guys do this? How does this happen? Didn't you think about this and the other and the other? And it's like, well, kind of, we did actually. And we asked you and you didn't tell us what you thought. And here we are. Anyway, I'm going to wrap up. Sorry.
Just on that note, my ask would be that for investors, when you're talking to companies in your portfolios or that you're looking to invest in, tell them to start disclosing in line with ISSB. Look at OSFI, right? The Office of Superintendent of Financial Institutions here in Canada has already indicated publicly, and it's been affirmed or reaffirmed, that their climate disclosures will be aligned with S2. We want to bring alignment here in the Canadian market and globally. So yes, please, investors, when you're talking to companies, if you're talking to regulators, we need to have the regulators across the country, look at, like we have on the financial reporting side, to adopt these. So there's a role there. And I thank you very much for highlighting that investors' voice is so very important in this conversation moving forward to adoption. Okay,
last question. Charles sent in another question. How do you reckon, and we talked about this, but I guess let's just synthesize this point. How do you reconcile the inherently and sometimes vast difference between various rating agencies for the same company, and especially for polluting companies or fossil fuel companies? How do you do that and then say, okay, look, but they have a high ESG rating?
Yeah.
How should investors think about those 2 points?
Great question. I'm going to try to. I could go on for hours, but I won't.
Know.
Okay, so the analogy I'd make is, how could 2 investors have a completely different take on the same company? Say, well, gee, one's growth oriented and one's value oriented. So you can look at the same data sets and different approaches. First thing is, rating agencies can have very different approaches to rating. Some take a very ESG risk focused, Others take more of an impact focus. So that's number one. But number two, and there are other reasons, the lack of disclosure is a real problem. So some of that disparity, and I agree with what you said earlier, diversity is good. But when any of that diversity is driven by the lack of information, where ratings
Right.
providers are having to create models and, basically guess on information, they don't have that's a problem. And I'm very excited about what we're doing on the ISSB side, because I think it's going to make those ratings better. I think there's still going to be diversity, but I think the convergence is going to be real there, because they will all be dealing now with the same foundational set of sustainability data. It'll be higher quality. Again, it'll be assured. It'll be audited. Then you can just have smart people and smart technology, leverage that data, and they can come with different conclusions. That's fine. So I think that, diversity is good, but let's make sure diversity is at least grounded in that same data set. And I'm really excited about the work we're doing to address that challenge in ratings.
Great. Thanks for that, Michael. Always ask my guests here in closing, favorite book or book you'd like to pass on that's had impact in your life and your career, learning and otherwise?
Well, it has not, it's not investing specifically, but
Good.
I'll tell you that, like you, founded a firm and grew a firm, and so leadership and culture is something that I care a lot about. So, the servant leadership is sort of the style that I tried to do. So Greenleaf was a person who really got that off the ground. So, a leader providing the tools and providing the space and the support for others to achieve their greatest success. So anything on servant leadership, as I call it, or it's been called more broadly, those have been really impactful. That's been very impactful on my career in building a company and how I try to deal with people when I'm in a leadership position.
Favorite podcast, if any?
Well, I'm a sports fan, so, generally, and right now, I'm a football fan. So anything related to the National Football League, I enjoy.
Favorite team?
Well, sticking with football, I'll say Pittsburgh Steelers. I'm also a big Blue Jays fan.
I can't believe it. I knew we were separate. We must have been separated at birth with this whole independent research thing. Steelers all the way. We bleed black and gold. That's how it works. All right, last question. Breakfast. Favorite breakfast and where you might have it, the restaurant. I'm a big breakfast guy.
Listen, can I just say I make great breakfast here.
Sure.
We live in the country. I've got a lot of food here, so a lot of it's fresh. As long as it's fresh food, you can do the bacon and eggs, you can do, granola and fruit. I don't care. I just like fresh stuff. So I'll say my breakfasts that I make here are the best, Anthony.
I like that. With that, I'll sign off. Thanks, everybody, for your attention today. We're going to be sending out the replay. We'll have links to S1, S2, and as well as other supporting things that we found that the ISSB has pulled together. Thanks very much for your time, Michael.
Thank you.
Bye-bye, everyone.